With me today, I have David Jane, fund manager at Premier Miton, responsible for running a number of multi-asset funds, including Premier Miton Cautious Multi-Asset. Hi, David. Nice to see you again.
Hi, Lee.
Now, David, the Cautious Multi-Asset Fund did what it is designed to do during the crash. I mean, it fell far less than many other fund styles. It's outperformed its benchmark since the March low and is currently trading near a record high. Could you please just sum up 2020 for us and for the fund and for you as a manager of investments?
Well, of course, I'm sure as everyone knows, 2020 has been an extremely difficult year for all investment styles. But for a cautious fund, of course, this is where we should come into our own. And we were very much taking a fairly cautious stance through the end of last year into the early part of this year. Of course, we didn't know quite how things would pan out, but economies were broadly slowing already. So we had been reducing our equity exposure, extending the duration of our bond exposure, and building up the gold exposure in the early part of the year. Then, of course, when the COVID crisis hit, we sold what we should do. Following the process, we sold the consumer cyclicals, anything travel or leisure related, and we were very aggressively selling through February into the start of March. Once March panned out, we were looking at our equity weights in the portfolios, all the portfolios we were on, and we discovered that they were very much at the lowest they've ever been throughout the history of us running these kind of funds. And we just thought, we don't know when markets are going to bottom out, but we do know that given our mandates, given our style, our equity rates are rather too low. So we sat back and said, look, time now to be buying. And we started to buy equity around the end of March. We didn't know this would necessarily be the bottom, but we did know that appropriately our equity weights needed to be a good deal higher than they were at that time. Then, as it turned out, what of course should you buy at that time? Again, aligned with our process, we bought the things that were doing well, and the things that were doing well, both in stock market terms and in fundamental terms, were what we call the digital disruptors, the internet related business, payment services, such things as MasterCard and Visa, which are businesses that clearly would benefit from the move away from the cash and the move on to online shopping. And those things did very well through the recovery and throughout the rest of this year.
Okay, what is about the current makeup of the fund and the weightings of the different asset classes? You say you were picking up equities in March. What does the current makeup of the fund look like, and what does it tell us about your view of the world?
Well, very much having bought those digital disrupting businesses, we went on to extend that through into robotics businesses, renewable energy businesses, and such like. And therefore, our equity weights have become relatively high. Really, through the summer and the early part of the autumn, we have been trimming, but of course equities are still rising, so our equity weights still remain relatively high. That might suggest we have a positive outlook on equities, and I think that's fair enough. I mean, I think we do have a relatively positive outlook on equities at the moment. We're looking at a global economy that clearly has contracted an awful lot, and the deeper the contraction, in many ways, the stronger the recovery when it ultimately comes. And markets are now starting to look beyond perhaps second lockdowns, beyond the economic contraction, and starting to look at the pace of recovery that you're likely to see. We can't really predict that when that will take hold. I mean, clearly there's been a significant rally in economies from the low, but we do know that it will at some point start to grow much, much more strongly. And so markets look 6 to 9 months ahead, and they're saying, come next summer, we'll have passed the lockdowns, we'll have passed the vaccines, and economies will be growing strongly. So we are now looking at portfolios and saying, should we have more cyclical bias in portfolios? Should we have more value bias in portfolios? Are those the opportunities going forward? We haven't acted very strongly yet, but we have acted to some degree on that view.
Well, David, I mean, you mentioned value. Is value now a style, investment style that you think is viable after years of playing second fiddle to growth?
It does tend to be, a very seasonal pattern value and growth. I mean, if you look at value as an investment style, it tends to perform in the early part of an economic cycle when bond yields are rising, when yield curves are steepening, and when cyclicals are getting going, because cyclicals are always value, financials are always value. And these things, obviously, in an era where bond yields have been consistently falling for many years, value will obviously be out of favour. But we've now perhaps put the lows in bond yields. We've started to see a reasonable rise in the US 10-year rate over time. And if that continues, you will have a period of time. It may not be for very long, but you will have a period of time where value outperforms. Now, clearly, we have a thematic approach to our portfolios as well as the macro side. Clearly, the thematic growth names will still be thematic growth names, and they will still continue to perform. But this could be a short or medium-term period where we need a lot more value in portfolios in order to do well in the coming year.
So you've still optimistic on equities. So, I mean, is the portfolio already positioned for 2021? I think you said you were still sort of making some, still in a discussion phase, perhaps, or is there, there's still some tinkering to be done with the portfolio as we, deep into Q4?
We in our process, we don't really like to try and predict forward what we'll be doing in 3 to 6 months' time. We very much try and deal with the here and now. We have a degree of momentum style within our process. And so we'll generally be thinking, what is the right portfolio to run for the market as we see it now? And as we see it now, we can see there's a nice balance between perhaps the growth themes in renewables, in digital economy, in robotics, balanced against some degree of value recovery in energy, in banks. Now, if we move it any strongly in one direction or the other, it will reflect changes in the fundamentals at the moment, whether that's bond yields or economic activity. If that changes, then we might increase our cyclical bias, or we might do the opposite. We might go strongly back into the long-term thematic names. But at the moment, we're happy where the portfolio is. I would expect that the likelihood is that the data is going to pan out in terms of accelerating growth over the coming months, in which case we're likely to be increasing, perhaps financials and other value type names over the coming months. But we will only act on the information that we get in coming months. We're not going to guess changes